we came up with this equation: asset equals liability plus equity. However, we have a problem of dealing with this revenue minus expenses equals the profit. How are we going to incorporate this revenue expenses equals the profit into this asset liability plus equity? So let's try to expand this asset liability and equity equation. So in here, as you can see, the equity is not only composing of capital or of a capital contribution, but also it's composed of profit. We arrive profit from revenue minus expenses. So again, this equity is composed of capital contribution plus the profit. So we can expand now our equation from just simple as asset equals liability plus equity. Now we have equity is broken down into contribution plus revenue minus expenses. So our expanded formula will be asset equals to liability plus contribution plus revenue minus expenses. These two, revenue and expenses, generate profit or loss. This is arising from the business operation. This contribution is not arising from business operation, but it's arising from capital contribution from the owner of the business. So we can demonstrate, or we can understand more about this equation, expanded equation, by having some transactions for demonstration purposes. Example. Okay, for initial capital, we have 100,000 in here, and we put that as part of the asset, and that's part of the contribution. So our debit and credit in this transaction is equal. Bank loan, we put that as part of the asset, and on the other side, a liability. Sales, we put that as part of the asset. Then we have revenue here. We put that here, the 300,000. Okay, and expenses, as a decrease in our asset, will be put here under the expenses. So here, the total asset is 270,000. Our profit in here, 300 minus 180, we have 120,000. Okay, so we add that to the equity to 100. We have now 220,000 as our total equity. Now we add this equity to our liability, 50,000. We have 270,000, which is in here. So that is a proof that our credit side is equal to our debit side, the total asset. Okay, so I hope you understand this flow to understand more about this equation on expanded form. But again, going back to the basic equation, it is only asset equals to liability plus the equity. But we need to address to capture the other operations, operation transactions like the sales expenses. So to capture this one, we need to use the expanded asset equals to liability plus contribution with the revenue less the expenses. Now we can understand more about this equation now, okay, in this manner. Okay, now in the future we are going to use account titles in order to account each of the transaction. We cannot just use assets, liabilities, and equity every time that we account transaction. We have to use account titles. So we have here a few examples of account titles. I'm going to explain to you what are these so that you can understand in the future on how to use this one. Let's say cash, that's the cash. Something coins, what we have in bank, those are cash. Accounts receivable, if we deliver goods, rendered services to customers, but that's on account, it means to say that we haven't yet received cash. So we account that one as accounts receivable. At the same time, sales, of course, which in here. Or if that is a rent, we put that as rent revenue. Or if that is a service revenue, put that as service revenue. But on the debit side, we put that as accounts receivable. Inventory, this is if your business is selling goods, you are in trading, means to say you should have inventory, of course. And those inventory, those items that are towards sale, those are what we call inventory. Prepayments, if you paid, let's say, rent in advance or insurance in advance for the year, then those are prepayments. We call that one as prepaid expenses or prepayments. So you can call that as prepaid insurance or prepaid rent. Furniture and fixtures are what we have in the inside the office, or in or what, let's say, those tables like that. Aircon, that's part of no, aircon is equipment. Building, no need to explain this one. Equipment, of course, you have aircon, computer equipments, those are part of the equipments and other equipments that you have inside the business. Land is what land, yeah, the land that is used in business, where they are building used in business. You put a structure over that land is to be declared under this land. The patent is like if you have some invention, then you acquire some patent on that in order to protect yourself from being from the piracy. So you use patent. So those are a few examples of the account titles under the assets. So these are the assets. Okay. As we go more and more over the some exercises in the future, we can be more familiarized with this and also with the other assets. Let's move to the liabilities. Number of example is accounts payable. Now, if we acquire, let's say, goods, because you are in trading, you acquire goods from your supplier, or yeah, you acquire like supplies, your suppliers, and you have not yet paying that. So you put that on the credit side as accounts payable, and on the debit side as inventory. It could be an expense. Let's say you have acquired supplies, office supplies. You put that expense, but at the same time, you put that as a liability. Okay, so they're both on the credit. Okay, that's very important. I need you to understand that. Unearned income is if you receive payment from the customer and you have not yet delivered goods. If you're in the trading, or if you're in the service entity or a service business, if you have not rendered services and you receive payment in advance from the customer, that is unearned income. Okay, that is a liability. You owe to your customers because you need to render in the future services to him or her. Next is the salaries. If you haven't paid your employees at the end of the month, if you need to declare your payable to the customers, that is to be accounted as salaries payable. Loan that is obtained from the bank. Mortgage, if you have a huge amount of loan from the bank and you collateralized your building or land, that's the mortgage payable. Interest is related to this liabilities, loan and mortgage, which is not yet paid at the cutoff date. Okay, so much for that liabilities. There are a lot of liabilities in the future. We have bonds payable, we have other types. Okay, so that would be encountered in some future examples or accounting of transactions. And here the third one is the equity. So in equity, basically we have only the owner's capital and the owner's drawing. In a corporate structure, we have stockholders' equity, we have retained earnings, and we have some dividends like that. Those are part of the equity. But in here, we just use simple. We have that sole proprietor business, form of business, in order to have easy understanding of demonstrating this equation: assets equals to liabilities plus equity. Okay. Now, on the other hand, the revenue and expenses. For the revenue, these are the example. Sales, if you are providing rent, that's a rent revenue. Providing service like laundry, that's a service revenue. You can call that as laundry service revenue. If you have some machine, or like a vulcanizing shop, that's or a repair shop for the cars, so you can call it as the repairs service revenue. The interest income, you could use interest revenue or interest income if you are in the financing business. Okay, but if you're not in the financing business, the interest income is used as if you have interest income from your bank deposits, long term or short term, you can use that. Other income, if we have incomes that are not falling under this here at the above, you put that one as other income. But again, you can at any time you can make your own account title just to be provided for a particular account without using this other income. Okay, other income is just some transaction or a few transactions that are not really usual in the business, so we use the other income. Expenses here. Utilities are for like what do you call this one, like electricity, water bills. Those are basic example of utilities. Rent, no need to explain that. Salaries, subscription, like you subscribe to some magazines, you subscribe to what do you call this one, like software, or that if you have no software expense provided for that particular nature of expense, then you can use subscription. Okay. Supplies, if you have office supplies like that, that's supplies expense. If you have other supplies, you can use also supplies expense. And interest expense, again, if you have some interest that are paid for your loans like that, you use interest expense. Even if you're not paying it, but you are in the cutoff date and you need to recognize or to record expense, you need to use this interest expense. So other expenses are for those that are unusual for the business, and you cannot use any of the existing chart of account titles in your chart of accounts, then you can use the other expense. Okay, so in the next section we are going to have this few examples of transaction to get you an idea about. There are some really we need to understand more that could enhance your understanding about this equation of the double entry system. So first, this is very common. We receive cash capital contribution amounting 150,000. So we plot that in here, asset and contribution. Okay. Then we purchase supplies on account 8. So when I say an account that is not yet paid in cash, that is payable. So supplies, that is an expense, right? If we try to go back here, okay, so we put that expense 8,000 at the same time as a liability, because that is an expense that is not yet paid, so that would be a liability in here, accounts payable. And in here, asset 15,000 for the laundry services rendered for 15,000 on account. Means to say that you have not yet received the 15,000 when you rendered that laundry services. So you put the 15,000 as accounts receivable, which is part of the asset, okay, and as revenue in here, sales. That would be your laundry services or your service revenue. And for the last one, paid advance rent of 12,000 for 1 year. So that is an advance. As I said, advance should be accounted as prepayments. When you pay the prepaid advance 12,000, that would increase your asset, right? Because the prepayment is an asset. But at the same time, since you use your cash, that would be also a decrease of your assets. So the movement of that transaction only involves asset. Increase in asset for the prepayments and decrease in asset for the cash used to pay for the prepayment. Okay, so that's it. So I hope you understand this one. There are some exercises. Just send me message to our FB page for more exercises again and for more understanding, and you can assess your learning level of learning about this topic to make you ready in the next level. Okay, so thank you.